Hello, hello. Happy Friday, and welcome back to another episode of Fridays with Flo. And today we're breaking down the Brrrr strategy for real estate investors. If you haven't heard of the Brrrr strategy yet, it stands for buy, renovate, rent, refinance, repeat. That is the Brrrr strategy. And so this is a method that real estate investors do if they're looking to build their real estate investing portfolios. So for those of you who are looking to build wealth through real estate and buying properties on the cheaper side because you don't have 20% to put down on the investment property, this is kind of that entryway. That's that loophole of being able to get in there. So today we're going to be breaking it all down for you. All right. So stick around and I'd love to hear your thoughts in the comments. Again, if you're tuning in from YouTube, don't forget to comment, like, and subscribe, and turn on your notifications to tune into every Friday with Flo episode each Friday. All right. So we've broken down number one, what the Brrrr method actually means. Again, we're rehabbing the property, otherwise known as renovating. We're renting the property out, putting a tenant in there. And at that point in time, we're gonna refinance the property and do the same thing all over again. That's the buy, renovate, rent, refinance, repeat process. And here and there, you can kind of do the refinance before you do the renting part. Of course, that's going to make it a little more challenge getting a lender to agree to fully refinance you without a lease agreement in hand. There's some other stipulations in place. It's much easier to refinance when you have a lease agreement because the bank, the mortgage company, can confirm exactly what the home is worth and what people are willing to pay for it, and confirming that the rent is indeed covering the mortgage. So here we go. Let's do it. Number two, the buy part is where deals are made. The first part of the Brrrr method is the most critical. Buying the property at a really good price at a steep discount means everything to the rest of the deal and it making sense for the rest of the process. So typically, investors are buying properties off market. And if you're buying properties on market, which I do at times, we're buying properties that are listed on the MLS. For those investors, we are really working hard to negotiate and make sure that this fits the formula, the 75% formula or the 70% ARV formula. If you're not familiar with these, I teach real estate investing 101 classes about every month. You can find them on my Eventbrite. So click the description. You'll find the link tree to my real estate investing classes and all the Eventbrite. You'll be able to access all the sessions. So we break down fully understanding deal analysis and formulas. On this episode, we won't be able to break things down, but pretty much understanding that there's a method to the madness of buying investment properties cheap. We're not just throwing spaghetti at the wall to say, I'm going to buy it for a certain number, just to say that. We're really doing a deal calculation. We are looking at number one, what is the property going to be worth when I'm done? Right? So when it's complete, when it's all updated and ready to rent, what is the property going to be worth? And how much can I rent it out for? That's very important information for an investor to know. And once we understand that, we're also looking at some comps to help us understand what it's going to be worth and what rent is going for. We're looking at what are some updated homes selling for? What are some updated homes renting for? And that kind of gives us a clear idea of what we can expect every month. Okay. And so once we have those numbers, we then plug that ARV, that after repair value, we plug that into our kind of formula of 75% or 70. 70 is going to be more conservative. Then we subtract the cost of the rehab budget. And once we subtract that, that gives us our maximum allowable offer. Doing this formula is how investors figure out the maximum they're willing to pay for an investment property. Okay. And so if the deal can work out to buy it at that number because it's already accounting for the cost of the rehab and already accounting for some room for equity in there, then that is the price we are buying at. So that's the first one. We've bought the property at this point in time. We're buying it below market value. We're planning ahead for the upgrades and renovations that's needed and making sure that we're building some equity in there for the refinance piece later on. The third thing that we do after we bought it, we're now in the rehab. Rehabbing is exactly how we get the property to increase in value. We hire a contractor or we do it ourselves. I don't do it myself. I don't have time to renovate my properties myself. That's a lot of work. I might manage the project, but I hire contractors and subcontractors to handle everything I need done. The flooring, the paint work, the foundation work, the electrical, plumbing, whatever that I'm doing, I hire contractors to manage the rehab. And of course, ahead of time before I close on the home, I've already contacted a contractor to look at the property and give me a quote and estimate. So I am clear on exactly how much it's going to cost me to renovate this home. This was already completed in the buy part. That's how I figured out my rehab budget. And so now that we're rehabbing it, we're ensuring that we're not going over budget. And if any, because it's always going to happen, not too much over budget. We're dealing with a lot of stipulations, maybe permitting. It's a process. So dealing with those pieces of the puzzle before we get to the finish line is a part of the Brrrr experience. This is how you add value in the home. You're forcing equity. The rehab piece of the Brrrr method forces equity, right? Because if you buy something that doesn't really need much work, or even if you think, oh, it needs some work, but the seller is pretty much delusional and thinks that the home is worth way more, but it's like, well, there's a lot of work to do it too. Sometimes you got to convince a seller and let them know, hey, there's a ton of work that's needed in this. And you can either do the work yourself and actually sell it for that price, or sell it to me and I'm willing to do the work, but I need you to reduce the price down to make sense. And so otherwise you overall in the rehab process, you're trying to force equity. So you're taking a home that you bought at, let's just say $250,000, pretty much increasing the value tremendously to $400,000 to $550,000 typically, right? Maybe $375,000. Overall, you get the concept of rehabbing forces equity. It forces appreciation. There are a lot of folks who can't afford to renovate. They can't afford to increase the value of the home. And there are a lot of markets where this is not necessarily going to work. Let's just be clear there, okay? That's why we do in the B part of the Brrrr method, we're looking at comps ahead of time before we buy it to figure out what is it going to be worth once the renovation is done. Because if the asking price or the sale price is way too close to what it's going to be worth by just $50,000 or sometimes even $100,000, that's really not going to work well for you, especially if you are trying to build equity and try to refinance later. Sometimes it might be better off for you to do that. If you're going to move in it, it'll make more sense. And that way you could do like a more traditional loan versus like a DSCR loan, which has higher rates, require more equity, more down payment. But for somebody who is trying to force appreciation or force increase of the home value, typically it's very important that you buy the property at a good price and make sure that that rehab budget doesn't go too far over. That's why buying at a good price is so critical, because oftentimes projects go over budget. And you want to make sure that there's breathing room to deal with that going over budget experience. All right. So the fourth piece of this process, the Brrrr method, is the rent piece. Now that the renovation is complete, it's good to go. And I do think it's very important with the rehab piece that you hire quality contractors, people who are going to do good work. I don't believe in sloppy quality work. I don't believe in just putting every cheap, dirty, bad thing in a house. You're going to end up paying for it again anyway, right? You do it the cheap way, you're going to get tenants coming back and asking you to come back and fix something. And it's going to constantly be something that you're putting money back into, even though you spent a ton of money rehabbing it. So I think it's better to do it right the first time and put good quality floors, good quality countertops. There's some ways to save money without overspending, but doing it the cheap way is definitely going to cost you more in the long run versus doing it right the first time. So when you put it up for rent, that's when you got your lease agreement, and you want to make sure, of course, from the work that you did at the B stage, the very first step, you already know what it's going to rent for with this updated, newly renovated position. And so we're going to rent it for that price and hope that everything's still the same. Sometimes the months and time it takes to fully finish rehabbing a home can mean that the market has shifted a little bit. And so if the market has shifted, that also means that maybe you're getting slower tenant demand and you're having to reduce the price down a little bit until you can get somebody to bite, and actually rent that home from you. Maybe you're offering half off the first month. In this current 2026 market, a lot more inventories on the market for sale and a lot more inventories on the market for rent. And so that means that there's a lot more competition for landlords trying to get homes rented. And so you're going to have to really have something good quality that is going to entice a tenant to move in, whether good location, good renovation, and good pricing. People are not going to overpay for low quality work anymore. We're not in that kind of market, that pandemic market where there was scarcity of inventory. So those are some important things to keep in mind. Of course, screening people is going to be very important, and every investor is different in how you look at people and the world. People always have their criteria, and every state is also different. I know there's some states that require first month's rent, security deposit, and last month's rent. North Carolina, that's not a thing necessarily. We just require first month's rent and security deposit. That's it. We don't collect last month's rent up front. And so that is also going to play a role, but then also figuring out, are you willing to entertain people who are below 600 credit score, mid 600s or higher? I mean, I like to take into account the economic factors and what's going on in the world, because if the majority of people coming your way are in the 600s, but you have a minimum credit score of 700, you're just costing yourself a lot more. So one of the things I get investors to think about is, if you are trying to get the home rented out for $1,800 a month, it would take you going down $100 down to $1,700 a month for it to actually work. But then over the span of a year, just going down by $100 to get it rented out this month versus losing another month of possible $1,700 of rent is just not worth it. It doesn't weigh the same, right? So I say go down $100 to get it rented for this month versus going another month or two of losing $1,700 month after month until you get it rented, just because you're trying to stay at that $1,800. I hope that makes sense. The screening piece is very important. And most importantly, you want to make sure that your rent is going to cover the mortgage when you refinance. That's why I said earlier that sometimes refinancing can come before the lease agreement. And it's kind of very important so that you kind of make sure that you know what that mortgage payment is going to be. You don't necessarily want a negative cash flow. Then you're going to have a hard time getting a lender to finance a property that is negative cash flowing. Now, this information is really relevant for those who are buying properties in the name of their entities, their business, and not in their personal name. So they're trying to qualify or refinance the home based on the rental value of the home and not their income or personal bank statements and that sort of stuff. So that's very important information to keep in mind. This method and the way I'm giving this information is really focused more on that strategy. You can certainly do the Brrrr method and refinance in your personal name, and they're always going to require 20% down for an investment property. But some of the things you can qualify based on your income if it comes down to it. Just be prepared to bring a ton of documentation and a blood sample to qualify for a traditional loan to refinance your investment property. So we've done with the rent part. The last thing that is a part of the Brrrr method is the refinance piece. This is where you refinance with a lender. You're going to work with somebody who pretty much pay off your initial mortgage loan, typically hard money, private money, maybe you're paying yourself back, then people who do that route, you're going to refinance with a mortgage lender that can do a DSCR loan, which stands for debt service coverage ratio. So this is a loan solely based on the rent and covering the mortgage. So if the mortgage lender and the appraisal value can justify the value of the home and the amount that you're getting in rent, typically they can solely move forward on giving you this mortgage loan for this investment property solely based on the rent covering the mortgage. And you need nothing else, And so it's a really great route for a lot of investors. You do kind of pay a slightly higher percent of interest rate. You definitely need 20, sometimes they require 25% down. That goes back to that formula earlier where we talked about 75% versus 70%. Typically, if you're buying an investment property, you need to put 25% down, sometimes 30%. So if we're looking at 100%, 75%, plus 25% gets us to 100. And so the bank wants you to put 25% down, typically for an investment property. So when you're buying the property up front, you're going to buy it at the 75% ARV formula, or 70%, which is even better, more conservative, more room for mistakes in terms of closing costs. It's more room if you go over budget with your rehab. It's more room for that sort of stuff. But that 25% difference of between 75 is your down payment. That's your equity that you're going to use without you bringing any money to the closing table when you refinance. All right. So those are the most important and critical pieces to the Brrrr strategy. Of course, we've only knocked these out in a short time span here on this session. But if you're looking to invest in real estate, I highly recommend that you check out therestorativecollective.com. This is a platform for real estate investors, especially newbie investors looking to invest in real estate. If you're looking for mentorship, access to playback on-demand education of all the things that's encompassed in the world of real estate investing, this is definitely the platform to start with. Just taking access to all the playbacks of all the 5 real estate investing classes and deal analysis calculators, guides, the real estate investing playbook, and all the materials. That first package called the Investor's Vault is available on the website for $497. Just under $500 is your only investment to get access, instant access, on-demand, self-paced access to education that can empower you to understand the world of real estate investing, including the Brrrr strategy. And so the classes include Real Estate Investing 101. It'll also include Real Estate Investing 102 that talks about financing, 100% financing with a hard money lender. And 103 talks about contractors, working with them, lien waivers, protecting liabilities, insurance, all that sort of stuff. 104 talks about refinancing, truly diving deeper into the Brrrr method, refinancing, doing a couple of different strategies with your investment properties, whether it is Airbnb, rent by the room, maybe you're choosing to sell it, you identifying that exit strategy. And the last class, 105, is 1031 exchanges and LLCs. So we have a CPA that comes on there with a qualified intermediary, otherwise known as a QI, that handles 1031 exchanges. They're on there talking about all the things we should know as investors when doing a 1031 exchange, or when also establishing our businesses to buy properties in those business names. So all 5 classes are available in the Restorative Collective Investors Academy. So check it out. And if you're looking for mentorship, the Core Vault comes with everything I just mentioned that's in the Investors Vault. And it gives you private one-on-one sessions for coaching and so on. The Extended Vault just pretty much doubles your coaching sessions and the period of time you're getting coaching services from. So those are some things to kind of keep in mind and expect. So otherwise, you can tune into our Real Estate Investing 101 classes that are live on Eventbrite once a month, the last Saturday of every month, and stay tuned. All right. Thanks again so much for tuning in to another episode of Fridays with Flo, and I'll look forward to seeing some of you guys in the comments and interacting with us. If you have any questions, don't hesitate to reach out and see our information in the description below. All right. Happy Friday. Have a good one, y'all.